What is inflation and how does it affect crypto? Consumer price inflation hit a new 40-year high and it will soon get to close to 9%. The Russia-Ukraine situation creates uncertainty. Now the big question is, should you worry? And also, is crypto a good hedge for your money? In this video, I'll explain what inflation is in very simple terms. By the end of this video, you should know more about what inflation is than 99% of the people around you. And even more importantly, you should know how to handle it. Now, make sure to follow along until the end, as I will give you some pretty surprising facts about crypto as a hedge for inflation. Welcome to Crypto Skills, the channel that makes all the complicated crypto concepts easy to understand. Now, you may argue that inflation isn't really a crypto topic. It's more of a general finance term, and you are right. But the fact is that inflation is probably the single most important factor to understand when looking at the health of the economy and what you as an investor should do. So, in essence, you need to know what inflation is and how it affects the economy to be able to take fact-based decisions as an investor. But not only is it important as an investor, if you run a business, drive a car, or are buying or renting a house, inflation is probably affecting your finances. So, what is inflation? Inflation is the decline of purchasing power for the same amount of money that you have. So a simple example is that if milk usually goes for $2 and now it suddenly costs $5, you now need more dollars to afford the same thing. Your purchasing power just went down. And there are a few different types of inflation that actually cause this. One of the easiest to understand is demand pull inflation. This is a fancy term, but all it really means is that if there are more people trying to buy the same amount of products. A simple analogy here is the used car market. There are not many cars available right now, but the demand for them is high. As such, the prices of used cars have been going up and inflated due to the mismatch of supply and demand. Economists will describe this effect as quoting too many dollars, chasing too few goods. The second type of inflation is known as cost push inflation, and this is when there's an increase in production costs such as raw material and wages, and that's passed on to the consumer, aka you. A simple example here is if you're a factory producing headphones and all of a sudden there's an unexpected increase in the price of your components or an increase in taxes. Well, you're going to pass those costs along to the consumer, resulting in higher retail prices, and that's the cost to push inflation. Another type of inflation is the increase in money supply. If there's all of a sudden more money in the economy chasing the same number of goods, then surely prices will increase. We saw a huge influx in the money supply these past 2 years, with $5.5 trillion being added to the M2 money supply. But as I'll explain later, an increase in money supply is not always a direct cause of higher inflation. So how is it measured? When people go and measure the rate of inflation, the most common way that they do that is with a metric called CPI, which stands for the Consumer Price Index. The CPI was introduced as a way to measure the price of a basket of goods from one time period to another. Imagine you go to your favorite supermarket and you buy a few things every single month. For example, milk, eggs, toilet paper, Pellegrino sparkling water if you're feeling fancy, some fruit, clothes, and whatever. The point is that you buy the same basket every single month, and that basket ends up costing you $100 at the end of your shopping trip. A year later, you're on your usual weekly shopping trip to your supermarket, but after you go and check out, you look at your receipt and you go, my basket of goods cost $105 now. So what happened? The basket of goods has stayed the exact same, but now you're actually paying $5 more or 5% more for the same basket of goods compared to last year. And that's how inflation is calculated with CPI. The Bureau of Labor Statistics does this on a regular basis. They measure the increase of how much that basket costs. They report that number every single month, and they compare it to periods in the past. Okay, so inflation has been trending up recently, but what's actually causing inflation? How is it stealing our money, and what can we do to defend against it? Let's talk about causes first. The causes of inflation usually stem from the instability of the world and of the economy itself. Any imbalance of equilibrium in the labor market or price stability might inspire policies that would then cause inflation to go up. Because we have a labor shortage, the government might enact financial policies that might cause inflationary pressures. When it comes to the money supply, when we do put more money into the economy from stimulus checks and small business grants and whatnot, it technically should result in more inflationary pressures, but just because there's more money in the supply doesn't automatically mean there's more inflation. What really matters is where that increase in money supply goes. There's a metric we can look at called the velocity of money, which refers to the frequency at which money changes hands. When the velocity of the money supply is going down, it's basically telling us that the money supply might not be directly contributing towards purchasing goods and products. Rather, people are using the increase in money supply and going out and buying assets like real estate and stocks, which means that their money is tied up and not actually contributing towards the velocity of money. So my life pretty much follows that exact pattern. I find myself investing a lot of my spare money into the stock market, and chances are you probably invested some of your money into the market as well. By doing that, you have not contributed to the inflationary pressure. So, how does the government handle inflation? In the US, the central bank is the Federal Reserve. In the Eurozone, there is a European Central Bank. Other central banks you may have heard of include the Bank of England, the People's Bank of China, and the Bank of Japan. Central banks generally set a target for what they consider to be ideal inflation. They call this an inflation target. Their stated job is to set monetary policy and monitor how much money is newly created to match this target. They think it is bad if it goes too far over or too far under the inflation target. The thinking is that an average worker's wage goes up at the same time or more than inflation, then that's good for the worker. If inflation goes up too much compared to a worker's wage, then workers are able to buy less things with their wages. The Federal Reserve's long-term inflation target is 2%. But why does the central bank want 2% inflation? Why isn't it 0%? Wouldn't 0% be the ideal number for inflation? Well, there are three main reasons why the Fed wanted a positive inflation rate number. The first is measurement bias. So when the observed rate of inflation is said to be 1 or 2%, the true measure is probably actually lower than that, closer to 0. So just simply measurement bias would be one reason to target a positive rate. The second reason for positive inflation is that you want to avoid deflation. Now, deflation is the opposite of inflation, when the same amount of money you have today can buy more things tomorrow. At the same time, that might sound like a good thing. A deflationary environment incentivizes you to delay your purchases, and by doing so, your lower spending will actually result in lower income for producers, which can then lead to unemployment and harmful effects on the economy. In general, deflation is really bad, and the cost of a negative 2% inflation rate would be higher than the cost of a 2% positive inflation rate. Now, the last reason you want a positive inflation rate is the following. A higher level of interest rates gives the Feds a little more room to cut in the event of a recession. So it's a bit of a cushion that allows monetary policy to operate a little more through its traditional interest rate channel. And that totally makes sense. Cutting interest rates kickstarts lending and the economy. So in periods of tough economic times, that's one weapon that the Fed has to nudge the economy in the right direction. All right, so how is inflation stealing your money and what can you do about it? Simply put, if you put in $10,000 in a savings account and it earns a 0.5% APY, which will actually be quite high for it right now, at the end of 1 year, you will have $10,050. But in the meantime, if inflation is at a much higher rate, say 5%, the same goods you could have purchased last year would cost you $10,500. That would result in a net loss of purchasing power of around $450. If the inflation rate is higher than the rate that you can get a return on, then inflation is stealing your money, and your purchasing power slowly but surely is going down. Now, one of the strategies to hedge against inflation is to buy assets in the correct sectors. Let's look at what you can do to combat inflation. While stocks do get hurt by inflation, some stocks do tremendously well. Quote-traded commodities have historically performed best during high and rising inflation, such things as copper, gold, silver, iron, and oil. Another sector that does well is energy, so you could look into investments like ETFs that focus on the energy sector. Collectibles also do well during periods of high inflation. Doing some research, I find out that with collectibles, the real annual returns are positive during inflationary periods for the following three asset groups. Art was plus 7%, Wine came in at plus 5%, and stamps at plus 9%. When it comes to cryptocurrencies, you probably heard that Bitcoin is the perfect hedge against inflation. Now, I've looked into this, and Bitcoin is actually an unreliable hedge because it's 5 times more volatile than the S&P 500 and gold. So in this scenario, the correlation of US equity and Bitcoin returns suggests that Bitcoin may not deliver positive real returns in periods of unexpected inflation. While Bitcoin should theoretically have no correlation to the overall market and inflation, the reality is actually quite different. People move their money in and out of Bitcoin and into other assets in times of economic uncertainty. Now, it's important to notice that this all comes down to the time frame you're looking at. The volatility for Bitcoin can, of course, be a problem if you need the money in the coming 2 to 3 years. But if you're investing for the very long term, like 20 or 30 years, there's still a possibility that Bitcoin might be a good store of value. Now, if you're interested in knowing more about this and how you can live off a passive income from crypto, you should really check out this video where we discuss how much Cardano you need to retire in 10 years. So you heard it here first. Bitcoin might not be your best bet if you want to hedge against inflation in the short term. Now, what do you think? Is collectibles like wine and art the best way to protect your money? Or is crypto the way to go? Let me know in the comment section below. If you enjoyed this video, please hit the like button to show your appreciation for our efforts and consider subscribing to Crypto Skills so you don't miss our next bite-sized explainer video on crypto. I'll see you in the next video. Take care.